Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com tells us the major markets again hit new highs and that gold and silver could be set up for a major breakout. He also comments on the U.S. and Canadian dollars. John Rubino, author of several books on the economy, including The Money Bubble, takes a look at how the coronavirus is hitting worldwide trade and how fiat currencies are under such debt load they could collapse, leading to precious metals skyrocketing. Eric Hadik, CEO of InsideTrackTrading.com, examines how various cycles are at play, including the impact of disease on the markets and what the U.S. dollar is likely to do. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at Charts by Ross. Welcome back to the show, Ross.
Always a pleasure to be with you, Jim.
It's starting to sound like a broken record, if our younger listeners know what that is. Let's say it was on vinyl.
Yes.
It was on vinyl. Broken vinyl here that, again, record highs in the markets. Is this going to be a never-ending story?
Well, I mean, how much money does the Fed and every other central bank have, and how much are they willing to put in on every correction? And then you've got all these algo programs that, during Friday's a prime example, spends the bulk of the day doing nothing. And in the closing bell, in that last 5 minutes, the market rallies strongly with the S&P taking off. You've got such a small group now that is truly leading on the upside. The S&P, it's 500 stocks, the top 500 capitalized stocks in the U.S., and just a handful of these have been responsible for 40% of the upside action in the last year. So, if you're not in the top names, it's been an up year, but it's more mediocre than anything else. And it's one of those things that say if you're not in the index, it's a stock picker's market for the rest of the things that are out there. So this market will go until it gets eventually too tired, and the last support was back here at the beginning of February, that small correction we had on the coronavirus scare. And just like SARS, when the WHO made the announcement about SARS that it was now a global issue, and they put out the global warning, the market had been selling off ahead of that, and it literally turned on a dime, pretty much like happened this time. A week ago Monday, you had the market at its low when the SARS epidemic or the corona came to a head as far as the media was concerned. And since then, the market just hasn't looked back. So you got to let this thing run. It's surprising a lot of us, but you don't want to fight the trend.
Is there a setup for gold and silver?
Yes, this is really interesting here. We've been looking at this, the pattern in gold. We talked about this one in our reports over the last month or two, that this 18 to 20 month stretch that we've been in here in gold has had two corrections of styles that we're very familiar with, and then a pop to a new high at the beginning of February and pulling back from there. Well, this is the fourth time that I've seen this in my history of being around the market, the specific structure that we've got. And the implication here was that we would give back about Fibonacci 38% of the rally from last November up until the January high, that when we were up through 1600 for a matter of hours. And that support would be found on the Fibonacci retracement period, and that it would form either an ABC-style correction with two sell-offs or go into a triangle, and with the support being at the fib number. And that's exactly what has ended up happening here. This week we found support right where we should have, and we've turned the corner quite nicely, closing up decently on the week. And this has a chance to make a pretty good run, and I would think well through 1600 and holding it rather than the quick pop that we had initially. And looking at the silver market, it likes to make big corrections. And if we look at silver over the last year and a half, the first correction off the high was 38%. That was back in the fall. Then we've had a deeper correction, which was 55%, and it's been holding in above that level. So in silver, it likes to correct back either 38, 55, 65, or 76%. I mean, this is going back over decades. And this support level that we've had now at the 1745 level in silver is just absolutely critical. It got down there this week. It's bounced beautifully from there. And if it can get back and close through $18, I think you could end up with a good $1.25, $1.50 rally out of that. And there's no question that the miners would participate very well in that type of move.
Now, Tesla, it's now the most valued automobile maker on the planet, beating out Ford and GM combined, yet they're still making huge losses, but they're still attracting buyers, and they're putting a new lot of stock out there. What can explain that?
Well, you come to market with new offerings when the market is capable of giving it to you. The last thing in the world you want to be doing is trying to raise capital in a down market. And so, here you've got Elon doing probably, what he said he wouldn't do. He said he didn't need to raise capital just a few weeks ago. But I'm sure that the financiers around him said, listen, let's take advantage of this situation while we can. And it's not surprising to see that type of thing happen. So, if we look at it, it's the pattern coming out of the, remember this stock really just broke out at the end of December. It was a 400, last summer, back in May, June, we had a capitulation buy signal down under $200. The stock broke out in end of December, going through 400, and now we're sitting at 800. The price action here is the classic style of a long consolidation, and in this case, it was from 2015 right through until December of last year that it was forming this broad consolidation, and what now is definitely a base. But the vertical move into that $970 peak that it put in 2 weeks ago is a classic bubble pattern. The key here is going to be how the consolidation manages to form as we move along here. The big support is still, I would say, back at about $600. If it can consolidate and hold above 7, it can set itself up for another big run on the upside. And technically, you could tack on another $1,000 from where we are right now. That would be the style of what we saw in gold back in the 1976 to 1979 run. But the key is going to be how it absorbs the new issue, how well the price just maintains its uptrend. So we have some specific criteria that we used for both Bitcoin 2 years ago and for the cannabis stocks when they came off their bubble tops. So this period of consolidation will give us some nice trading characteristics over the next couple of months, and I think that for the more nimble traders, there can be a fair number of opportunities in Tesla as we go through the springtime.
The Canadian dollar, how's it been doing?
Canadian got knocked down with the oil market, and as you know, oil bottomed out around $50 here in the last couple of weeks. A bit of a double bottom in there. And the Canadian dollar, we got some downside capitulation signals on the daily charts. So it had a bit of an upturn in the second half of this week. It looks as though it will have some continuation on the upside. There have been a lot of currencies that have been hit with the strength that we've seen in the U.S. dollar. The euro is another one that now we're sitting at multi-year lows as far as the euro is concerned, and we've got some capitulation signals in there. Wouldn't be at all surprised to see a pretty good bounce in the euro. Maybe a pullback in the U.S. dollar, and if we think back to the comments on gold. If the U.S. dollar is going to give up a bit of ground, it would allow the precious metals to put on some action as far as the upside is concerned. So I think we've got a fair number of tradable opportunities in this next couple of months.
The U.S. dollar, how's it doing?
Right back to testing multi-year highs, just like the other side of the coin from the euro. You got the dollar index 99 and change at the end of the week. Good support was down at 96.5. This is it's in a broad upward channel. It's been in the better part of be just pushing 2 years now. It came off a big spike bottom, but it's had a small upside progression for the last year and a half, 2 years. The top end of that, more like 99.5, bottom end of, say, probably around 96.5. So I wouldn't be at all surprised that you see some type of a minor pullback in here. The index sitting, say, at 99 right now, probably pulls back to 98 or just under, and that shouldn't be a surprise to people.
Ross, thank you so much for being on This Week in Money.
Always a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at chartsbyross. Coming up, John Rubino, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to the show, John.
Hey, Jim.
We're hearing so many different things about the coronavirus, that it's a major outbreak, it's a pandemic. Some are saying it's just a hoax. I've heard that perhaps the Chinese government started this to stop the riots in Hong Kong and in other cities where they weren't happy with the government. Regardless of what it is, how are the stock, currency, and commodity markets reacting to it?
Well, as for what it actually is, the problem with authoritarian, secretive governments is that you never know what's really happening, and I include the U.S. in this. we are lied to so systematically that when something big happens, it's easy to interpret it in lots of different ways. So it would be nice if they would just tell us the truth, and then we'd have a better understanding of where we stand. Now, as for the impact of something like this, by the way, 2 or 3 interviews ago, you asked me a question about pandemics. I don't know if you remember that.
Of course not.
What kind of, it caught me a little bit off guard because it was something I really didn't think about. But, I went through the basics of it, how we're creating these mega cities where 25 million people are all jammed together and we're abusing antibiotics and creating all these superbugs that current technology can't stop. So it was just a matter of time before we had some giant pandemic. And, towards the end, I said, I'm scaring myself here. I hadn't thought about this for a long time.
Now I remember, I do remember you saying that.
Yeah, because, that was something that just wasn't on my radar screen, but you asked me a question about it. And as I went through it, it started to occur to me that this is actually a fairly serious black swan kind of risk that we should be aware of. And then like a week later, the coronavirus thing starts. So it was just a funny piece of timing. So, thank you for forcing me to think about it ahead of time, so I was kind of prepared when it did happen. But anyhow, we've created the conditions in which a pandemic of some sort is inevitable, and it could be incredibly disruptive because we're, a globalized economy where supply chains generally go from country to country to country, and you need all of those places and all of those sources of raw materials and finished goods to function for something like an iPhone or a modern car to be able to make it to market. So you disrupt any part of that supply chain, and you've got big global economic problems. And since China is maybe the most important link in the global supply chain, to have a pandemic originate there and apparently shut down half the country is a very big deal for the global economy. It's possible that, we can't know how this is going to play out in terms of the pandemic itself because, this is kind of new territory for us, and we really don't understand the virus that well or anything. But, in its worst case scenario, it's a depression level event because, if people can't travel from country to country, and if goods and raw materials can't travel along these supply chains, then economic growth will just crater. And all the debt that has been taken on the assumption that economic growth continues and cash flows stay robust and good credits stay good credits, all that goes out the window. And we have this mass global default. It's funny, that was always coming. I mean, we've created the conditions financially where something like that is virtually guaranteed. But now we've got this exogenous shock that could bring it about a lot sooner than it might have happened otherwise. We just can't know, in other words, whether this is the black swan that lands and knocks the global economy off a cliff, but, it could be. And something like this will come along eventually if this isn't it.
Were the markets in China in trouble prior to the coronavirus?
Yes. China quintupled its debt and then some to get us out of the Great Recession. They were the engine that basically pulled the global economy back into growth. But it left China with a lot of bad debt. And those chickens were coming home to roost, regardless. They were going to have some kind of a financial crisis, no matter what, just because they took on way too much debt. And a lot of it was really dysfunctional debt. It's money that some municipality borrowed to build a new road leading to an airport. And now hardly anybody flies in and out of the airport, and the road is empty, and there's no cash flow to finance the debt or to service the debt. That stuff is happening all over China. So they were going to have financial issues regardless. But this kind of guarantees some kind of a financial reckoning for those guys.
After the SARS outbreak, when China was only 5% of the world's economy, unlike the position they hold now, about 20%. But after the SARS outbreak, China injected a huge stimulus program to get the country back up and running. Do they have the resources to do that this time if this turns out to be much bigger?
Well, that's the big question, isn't it? Because they borrowed so much money before, and they haven't paid any off. They're still increasing their borrowings. So at some point, whoever is lending somebody like China money is going to be worried about lending them more, and it's going to be harder and harder to borrow. So it's unlikely that they're going to quintuple their debt again in order to revitalize an economy that's been hobbled by a new outside shock. So it's not clear, how you grow your way out of a pandemic that shuts the country down for 6 months, assuming that's what happens. We don't know, they won't be back to work in 2 weeks. But the way it's looking now is that this has legs, and that because of that, we should be prepared for kind of a long process of coming to grips with this. The virus seems to be fairly contagious and fairly dangerous, and it has a long incubation period, apparently, which means you can be asymptomatic but still be spreading the disease. So presumably for the first couple of weeks that it existed, Chinese people are flying all over the world and sitting in airplanes and in restaurants and in business meetings while spreading this virus. So it'll be interesting to see, what that does. What happens to, for instance, I'm not far from Seattle, and I've got to be in Seattle a few times in the next month or so. And now that's on my mind, because there's a couple of cases there already, and an awful lot of traffic between China and Seattle, which means that it could be worse there in Seattle than it seems now, just because the incubation period is long enough that we don't know what it's actually going to turn out to be. So, I don't think we know have any good answers for any of this yet. Just a lot of speculation and some fairly serious worst case scenarios.
And people have said one of the problems with the outbreak in China was that you have a hardline government that accused a doctor who blew the whistle of rumor mongering. They, criminalized him. It makes people scared to blow the whistle when something like this happens. Now, also being a hardline government, they can take drastic measures and not have a lot of bounce back from the people. Are there pros and cons for that kind of government handling something like this?
Well, there are pros and cons to dictatorship in general. Like you said, you can get stuff done in a hurry if you need to. So if your dictator makes the correct choice about how to go about something, they can just go ahead and do it. And that's better than it is in a democracy when you've got a bunch of people arguing, and then you've got to work it through committee, and then you've got to put it to a vote, and then you've got have to have someone sign the law. That takes a long time. Now, the upside of democracy versus dictatorship is that you empower a lot of different people to come up with solutions. So you've got a lot more brain power at work on a given problem in a democracy than in a dictatorship. You've got a lot less terrified people. So in the long run, a free society where people are able to speak out and the truth is closer to the surface always wins out. But in the short run, it's possible that a dictatorship can outperform a democracy. So with China, you pointed out the downside of this is that people are terrified to speak out because the government might label them, as seditious or whatever, like they did with that doctor. And by the way, the doctor he kept on treating his patients and he eventually died of coronavirus. And that's been the source of a lot of turmoil in China, where people are mad at the government over the way they treated this guy who turned out to be a hero. And in the U.S., or Canada or someplace where people are relatively free to speak out, that's less of an issue. The truth bubbles up a lot sooner. So, I think what we see in the U.S. and in Canada, if the disease comes here and actually has any kind of an impact, we'll be closer to the truth in time. In other words, we'll get to the true essence of what's happening sooner than they did in China, and maybe have a better chance to head off the worst of it. So hopefully that's the way it'll play out. Or hopefully, there is no issue to deal with, and that it just kind of peters out before it becomes a pandemic in the U.S. and Canada and Europe and places like that. But again, we'll see. No way to know how this plays out until it does.
People from mainland China have been buying up real estate and businesses around the world. Could the coronavirus cause them to repatriate their money back to China like what happened with Japan back in the early 90s?
Well, I don't know if, if you've got assets abroad and you're a Chinese millionaire right now, bringing it back to China may not seem like the wisest move, right? Because China's the epicenter of this big crisis. To the extent that China goes into some kind of an economic downturn and people in China need the revenue from their foreign assets in order to get by, then some money might flow back into China. But I think there's also a chance that a crisis like this leads to a lot of capital flight out of China. If you're rich and Chinese, and you've got some money left in your home country, maybe you want to move it out now before it sinks into chaos, So it's possible that this will turbocharge the exodus of capital from China, which just will debilitate the economy further. So, there are a lot of moving parts here, Jim. And it's hard to tell how any of this, how the parts interact exactly, because you've got politics, which is affected by both the pandemic and by the financial side of things. And you've got finance that's affected by both politics and the pandemic. And they're all part of this feedback loop. And it's probably a negative feedback loop right now in the sense that one bad thing exacerbates problems in another sector, which then makes things worse in the third sector, and so on until the thing spins out of control. But again, it all depends, at least in the short run, on how this virus goes. And if it doesn't turn out to be that big of a deal, like most things we worry about, usually you see these hurricanes coming at the coast and nothing really comes of it or not much comes of it. And there's an earthquake somewhere, but it's not the big one. And there are outbreaks of diseases. Remember Ebola a few years ago? That was going to just decimate Africa, and then it kind of faded. So it could be one of those again here. But it's important to understand that these external shocks can speed up the process of us falling off a financial cliff, but we're headed for that cliff regardless. So if it happens in 2020 because of the virus, but it was going to happen anyhow in 2021 or 2022, then it's not all that big deal in the scheme of things. We're in bad shape regardless. We're headed for a crisis regardless. So we want to get our act together now financially. So the advice for dealing with the coronavirus is the same thing as it would be for dealing with the eventual financial crisis. Get your money out of fiat currencies and into real assets. Pay off your debts. Make yourself indispensable at work. Connect yourself to your community as much as possible. So in return for your potential help, you've got friends who will potentially help you. Do all those things. You should be doing all those things now, regardless, which in a way is kind of a comforting thought, right? We should be doing the things that will help us with a pandemic already in order to help ourselves with the future financial crisis. So let's just do that stuff and not think about the immediate problem, because we've got longer term problems to prepare for.
We'll have more with John Rubino when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with John Rubino. John, how are the commitment of trader numbers looking for gold and silver?
Well, they've become irrelevant lately, Jim. The commitment of traders report, which is the structure of the futures market for gold and silver, it went really, really bearish for precious metals, back in the summer. And it stayed that way, which is to say that the speculators are extremely long in futures contracts, in both gold and silver. And historically, speculators tend to trade on trends and emotions, and which means they're usually wrong at big turning points. And they're extremely bullish right now, which is usually a sign of a impending correction in the metals. But they've been that way for a long time, and it hasn't happened. So this is possible, or possibly one of those times that everybody's been talking about as coming, but it's never come yet. When the physical demand for gold and silver just swamps the games that the paper markets traders play. And we get the fundamentals winning out. In other words, if there's a lot of demand for physical gold and silver bullion, which there is, because central banks are now net buyers instead of net sellers, then that's what determines the price. So if you got China, Russia, and India adding, massive amounts to their stockpiles of gold and silver, and you've got some of the other central banks now buying rather than dumping their gold on the market, then you've got the conditions for a fairly strong increase. And you've got all the central banks of the world suddenly or finally easing together. Everybody's going to cut interest rates in the next downturn, and every government is going to run massive deficits. And that's really good news for precious metals, because it means that in some way, on some level, inflation is going to accelerate in the fiat currencies. And it may be you could say that they're already being inflated away aggressively relative to financial assets like gold or like stocks and bonds and real estate, and now gold and silver. But I think there's a decent chance that if the central banks do what they're promising to do, that we'll see inflation in the consumer price index. In other words, people's daily living costs will start to go up. And that'll really spook the market, send a lot of capital into gold and silver, because that's where people hide out when they're worried about the value of their nationally run currencies. So all the stars seem to be aligned for a really good few years for precious metals. Mm-hmm. And if that's the case, then it really doesn't matter what the futures traders are doing, because in that market, if the speculators are all long, that means somebody else is short to offset that big long. And those, the guys who are short may be forced into a squeeze where they have to buy back their positions by going long. And the futures contract market becomes a source of positive pressure, upward pressure on precious metals to go along with everything else. So we could get a parabolic move out of that at some point where basically everybody's buying. So, supplies are limited, massive increase in buying pressure, and the price just spikes. That won't be right away, but it could be after, say, gold pierces $2,000 an ounce in U.S. dollars.
Do gold and silver look like they're stuck in a trading range?
No. Well, I mean, they have been lately, technically, but they've been going up for the past couple of years irregularly, and they were above 1,600 U.S. dollars in gold just lately. Then it's back down to 1,550, give or take. But gold could easily pierce $1,600 US and not look back. And then once it gets into the 1700s, 2000 becomes a very achievable target. And breaking through 2000 would be an interesting thing, because that would be the all-time high in US dollars. Gold is already at all-time highs in most other currencies. But once it breaks through here, then you've got a pretty strong technical case for a longer run. And again, all of this would happen with corrections and, backing and filling and stuff. It wouldn't be one straight line. But over the next year or two, that could be the dynamic where you break through, technical levels of resistance and then spike to the next resistance and then maybe break through that and on and on. So the fact that gold should be $5,000 to $10,000 an ounce should be very comforting to people when gold and silver are going down a bit as part of the correction in this new bull market, because that target that's out there will probably be achieved in the next, say, 5 years. And knowing that makes it easier to accept a $100 drop in the price or whatever, or a $5 drop in silver's price. Meanwhile, silver is extremely cheap to gold, relative to gold. So if gold goes up, silver will go up twice as much.
Your website is dollarcollapse.com. How far do you see the U.S. dollar collapsing, and in what time frame?
Well, I think all the fiat currencies are being so grossly mismanaged, and they have been since 1971 when Nixon took the world off the last vestiges of the gold standard, that you can make a good case for some kind of a monetary reset out there, where the big currencies are just so out of favor and they're falling at such a dramatic rate that we have to go back to some kind of a commodity-based currency standard globally. So there will come a time, I think, when on some Sunday night, the U.S. government just announces, okay, from now on, starting Monday morning, the dollar is just a name for 1/10,000th of an ounce of gold. Which is to say the value of the dollar falls from, 1/1600th of an ounce of gold today to 1/10,000th of an ounce of gold. That's a really big devaluation. And it's in some form coming. Either it's by government action because they figure out that this is their best of a bad set of choices, or the market just does it. And the value of the dollar just falls off the table relative to gold, which is to say gold just goes up relative to the dollar. So if gold spikes to $10,000 an ounce, that is a massive devaluation of the dollar. And I think we could see that very easily within the next 5 years.
Are banks currently conservative or liberal in their consumer lending?
Well, based on the amount of consumer debt that's being accumulated out there, banks are pretty liberal. In fact, everybody's pretty liberal because corporate debt is at record levels, and student loans are at record levels. Credit card debt is soaring. It's not at a record yet, but it's heading that way. Mortgages are starting to rise again. Home prices in the U.S. just keep going up and up. More and more people are taking out mortgages. So pretty much anybody who can borrow is getting loans from somewhere, which implies that the banks are handing money out to anybody with a heartbeat these days, and that's usually a precursor of a crash too. When you see debt spike like this, then it implies that the people who probably shouldn't be borrowing are borrowing from somebody, and they're going to stiff whoever lent them money. That's true already in student loans where defaults are rising dramatically. It's true in subprime auto loans where the market is kind of falling apart. It's true in fracking and shale oil in the U.S., where all those junk bonds that were taken on by the new age oil companies on the premise that one of these wells would keep on producing for years and years and years. And it turns out that the wells produce for 1 year, a little bit the second year, much less the third year, and then basically run out of oil. And making those junk bonds a lot less likely to be paid off. So that's happening in that market too. So we're seeing a lot of different markets where defaults are already starting to rise to troublesome levels. Now those are peripheral kinds of debt. But if they behave badly enough, then the trouble will move into the center. Medium-range corporate bonds, sovereign debt of countries like Italy and Portugal and Spain, and we'll see big trouble around the world.
The U.S. and
coming.
The U.S. and Canada have legislation already that allow bank bail-ins. In other words, they're allowed to dip into your bank accounts to keep themselves afloat. Is that worrisome?
Very much so. Yeah. I mean, if you have a bank account, because last time around the banks failed because of their own stupidity and greed, and we bailed them out with taxpayer money. We basically just put all the regular people in the U.S., at least, on the hook for Goldman Sachs and J.P. Morgan Chase and Citigroup. That is so unpopular conceptually now that it's probably a hard sell, even though the government would love to do that again. But it looks like they probably can't get away with it politically. So what they're going to do this time, it looks like, is if you've got a bank account, your bank fails, they're going to take some of your bank account and some of everybody else's bank accounts in order to prop up the bank. Which kind of defeats the purpose of the bank, doesn't it? That's a place where you keep your money safe, because you could put it under your mattress if you're willing to accept a little bit of risk. But a bank should be untouchable. That's where you're guaranteed to get your money back. And that's possibly not the case anymore. So I think it should terrify anybody who has a lot of their savings in a bank account. If you have a checking account where you're paying your bills each month with money that you put in from your paycheck, no big deal. You don't have that much at risk. But if you've got, $100,000 in a bank account, then you've got a serious problem in a world of bank bail-ins. So your listeners should think about who they are on that spectrum and act accordingly.
I've noticed on TV a lot more ads for the bank deposit insurance program where you're guaranteed at least $100,000 in your account, but they could change those rules overnight, couldn't they?
They could. They could definitely take the money that's over $100,000 if a bank gets into trouble, but they could easily take more. There's just no way to know. See, desperate governments do crazy things. If you go back through history, you see some amazing stuff when governments were going broke, and some of it included the death penalty back in the day. So you really need to accept the idea that what we think of as normal behavior now and a normal set of rules could change easily. And the government could do stuff that is just absolutely shocking as far as our money goes. And they could do it with the stroke of a pen. And governments historically have done things like that. So yeah, you could easily see capital controls where you're not allowed to move your money out of the country, and wealth taxes. If you have something that went way up, like back during the oil shocks of the 1970s, they had a windfall profits tax where if you were in the oil business, or I guess if you had oil stocks too, that got more valuable, they could take extra money away from you because you were doing so well and nobody else was doing well. That's the kind of thing that could happen with precious metals, where if you've got a whole bunch of gold stored in a vault somewhere and the government knows that you've got it, they could come back to you and say, well, you made 1,000% on your gold, and everybody in the stock market just lost 70%, and their houses are down, and why are you so greedy? Why won't you share with the rest of the country? So we're going to take a bunch of your gold away. That could happen very easily. So you just need to understand that what we think of as normal actually was a very abnormal time when governments and their central banks had unlimited printing presses, when they were able to create as much new currency as they wanted to and then manipulate the world with all that extra currency. Well, they're going to lose that power one of these days. And when they do, they're going to have to find some new way of exerting authority in the world. And it won't be pretty, because newly created currency from a central bank is a really painless way for society to be manipulated. But guns and restrictive laws and capital controls and wealth taxes, things like that won't be as pain-free for the rest of us when the government comes after our wealth in that way.
What can stop cryptocurrencies from going to zero?
Cryptocurrencies are a tricky subject because on the one hand, Bitcoin, for instance, has a predetermined rate of supply growth and then a fixed limit at the end of that process where there will never be another Bitcoin created, which on the surface makes it look like the soundest of sound money, right? It's got a fixed supply, cannot be created in infinite quantities by crazy governments. However, there's this, I don't want to call it a scam, but it seems like it is a borderline scam in the cryptocurrency world where, Bitcoin reaches a certain price point or whatever, and they just create a new kind of Bitcoin and kind of calve it off from the original Bitcoin. And it just goes on to rise in supply on its own track. Meanwhile, via initial coin offerings, ICOs, hundreds of new cryptocurrencies have been created, so that the total amount of currency in the crypto space looks unlimited. In other words, you can create as much new crypto as you want to just by issuing new coins and splitting off from existing cryptocurrencies. And so I don't know what that means. I don't know whether that's a kind of inflation that will wipe out the entire cryptocurrency space, or if it's a bubble like the tech stock bubble back in the 1990s where, 90% of the new .coms that went public with great fanfare go bankrupt in a couple of years, leaving some really spectacular companies that go on to rule the world like Amazon and Google. So that at the end of the process, you still got Bitcoin that's doing great, and you've got a few other cryptos, and most of the rest are gone. I don't know. The dynamic of that market is really mysterious to me, and I think we won't know, even though a lot of people seem to think they know, but I think we won't actually know until it does what it does. Once we see it in action over a certain period of time, then we'll be able to impute some laws of crypto finance that the currencies have to kind of obey. But until that time, I would just be careful. It looks like Bitcoin is probably a decent store of value, but we haven't seen anything yet that is a medium of exchange on any kind of scale. So one way cryptos might go is that they become the medium of exchange for a gold-backed financial system where the gold stays put, but the ownership of the gold changes hands via a cryptocurrency that can communicate value and transfer wealth frictionlessly around the world. I like that idea, and hope that that's the way it's going to work out, because then we could just totally bypass national currencies. We wouldn't even need the dollar conceptually, and I think that would be a much better world than today's world.
More and more electric vehicles are being announced. Is this bullish for the price of metals used in lithium-ion batteries?
In theory, yes, it is, because Tesla just took off lately, and it looks like that's the breakthrough product for the electric car revolution. I think a decade from now, most cars will be electric, although they may be run by fuel cells rather than lithium-ion batteries. That remains to be seen. But electric cars are just so much more sophisticated and so much more fun to drive, and in some ways so much more environmentally benign, although they've got their flaws too. But they seem to be better than internal combustion engines in a lot of ways. So the raw materials that go into electric cars will see a lot of demand going forward. Put that against the fact that the supply might increase dramatically as we look for more sources of lithium and all the other things that go into electric cars, and find them, because we just haven't been looking that hard up until now. So you could see booms and busts in the price of a lot of commodities related to EVs. And I wouldn't presume to have any idea where we go from here in the short run. It could be up, could be down, could be sideways. I have no idea. But I think in the long run, there will be greater demand, at least, if not much higher prices for a lot of these things.
Are you watching oil and natural gas?
Yeah, oil tanked on this coronavirus thing, didn't it? So that is good in one way, because it's like a tax cut for people who drive. It's bad in another way, because a lot of the junk bonds that we talked about before that have been taken on by upstart oil companies, the frackers and the shale oil guys, require oil to be a higher price than this for these guys to be able to make enough cash flow to pay off their junk bonds. So oil at 50 or, okay, let's say 50. Let's say it stays here, and that's not high enough for a lot of the shale oil guys to pay off their junk bonds. Then you have defaults which hit the owners of those bonds, whether it's bond funds or pension funds or hedge funds or whatever. And we see failures because of those defaults, which then spread through the system. And the question is whether that's big enough to metastasize into something more serious. The raw numbers in that category of junk bonds is bigger than the subprime mortgage market was back in the day. And the subprime mortgage market just about tipped the global economy over into a death spiral. So it's possible that that's the catalyst. But heck, Jim, we've got so many potential catalysts out there right now. It could be any number of things at any given time.
Is nationalism better than globalism for Canada and the U.S.?
Globalism was a really seductive idea, because you get a lot of efficiencies if whatever country is the very best at doing something does that thing and does it at a lower price than anybody else. So you get stuff being made much more cheaply, which in theory helps working class consumers, because they're the ones who are most stretched. in trying to cover day-to-day living. And if day-to-day living gets cheaper, that's good for them. But it turns out that you can't have a modern economy without a manufacturing base. And in the U.S. in particular, we allowed our manufacturing base to just shrivel up. And there were no other good jobs for the people who were thrown out of unionized, for instance, assembly line jobs. You know, if you worked at an auto plant and you made $40 an hour with benefits and everything, and you lost that job, there's no place you can go to get $40 an hour if you're a high school educated 40-year-old guy. You know, so you see a lot of those people now working as greeters at Walmart or someplace, and their lives have been destroyed by this. And that's why we got Donald Trump as president, because he spoke directly to that segment of the population that was most disadvantaged by globalization. And it turns out there are a lot of people like that. And there are enough people like that to win elections. So now in the U.S., you've got Bernie Sanders, who's kind of sort of a left-wing populist. You know, he's on the left the way Trump was on the right. But they're both speaking to the same group of people and offering a lot of benefits for those people. Trump promised to bring the jobs back by renegotiating our trade relationships. Bernie Sanders is promising to give everybody free stuff and improve their lives that way. So I think it's turning out that globalization needed to be moderated by policies that keep a manufacturing base in a given country on a scale that provides good jobs for people who are not going to go learn to code or anything, you know, and who really need to work with their hands and can do a good job in that kind of a job. So we're going to have to kind of wrestle with exactly what mix of policies are best going forward, because you definitely want to have relatively unrestricted trade. I mean, we need to be able to buy things from other parts of the world, but we also need to be able to make things here. So this is not simple, and it doesn't have evil on one side and good on the other. It's basically a series of trade-offs that we have to work our way through. And it's going to be kind of tumultuous politically, getting from here to there. But in the end, I think we'll come up, you know, the way life works is you muddle through and you come up with a compromise here and a compromise there, and you learn from your painful mistakes, and then you move on, you know, and you end up in, if you're lucky, in kind of sort of an okay place. And that's the way it's going to be on trade policy and on nationalism versus globalization in general. We're never going to find a perfect solution to stuff like this, but we're learning as we go. And if we approach it in good faith, you know, if we don't descend into civil war over stuff like this, or global nuclear war, then we'll be able to improve from where we are. But perfection will always be out of reach, because that's how humanity works. You know, nothing humans do is ever going to be perfect, because we have competing wants and needs, and we're wildly imperfect and we make huge mistakes. But I think the political side of this is going to be fascinating for the next few years, because populism, which is the nationalism expressed on the political stage in the U.S. and Europe at least, that's in the ascendance, and we're going to see populism get a try here, and we'll see how it goes. I'm not optimistic that it goes smoothly, but we might learn something from the process.
Are people around the world being turned into debt slaves by design?
Yes, they absolutely are. You know, it didn't seem like that for a long time. It seemed like we were just kind of blundering into stuff like this, but now it seems pretty clear that the 1%. Okay, there's a broader theme here, and I just published something today on this theme, that in a capitalist democracy, you have people who are basically free to manage their own financial affairs and then free to choose their leaders. But the capitalist part of that process produces winners and losers. So you have a few people do extremely well, a lot of people do pretty well, and then relatively few people do really badly. So it falls to the people who do really, really well to look out for the rest of the people, because otherwise the 99% will just vote to take away all the wealth of the 1%, right? You know, so it's in the 1%'s interest to be all about upward mobility, They've got to be setting things up so that regular people can see the next rung on the economic ladder and get there in a reasonable amount of time, because then they won't care if there are a few billionaires running around doing stupid billionaire stuff. If they can take their family from lower middle class to middle class. But if that's not possible anymore, then they look to the political side of things to get back from the people who stole from them. And that's where we are now. This class of rich people around the world have just harvested the rest of us. They are just cynical and greedy and are so short-sighted that they don't see their own interest here. They don't see that they've got this tidal wave of confiscation coming their way. What they're doing in response to the mess that they've made of the global economy is mostly buying bunkers in New Zealand with private airstrips so they can ride out the end of the world. Well, they're not going to get a chance to do that. President Bernie Sanders or somebody like him is going to come along and say, well, yeah, have fun in New Zealand, but meanwhile, we're taking your bank accounts and your houses and your yacht, and then we're working on a wealth tax with the New Zealand government, a wave of confiscation in which the 99% just suck the wealth out of the 1%. And that's a lot like the book Atlas Shrugged by Ayn Rand, where you get to a point like that, and then capital just goes on strike because there's no point in taking big chances with a lot of money, because if you succeed, the government's just going to take it all away from you. And then the system grinds to a halt. So we're in the process of creating that kind of a political financial feedback loop, and it's the fault of the rich guys who could have short-circuited that whole thing. They could have set things up so that, for instance, you made good money working in an Amazon factory, right? Or the factory that makes iPhones is in Illinois instead of China. That could have been done fairly easily, and instead they totally blew it. They went for every last penny, and now they're going to get every last penny taken away from them.
Are Agenda 21 and Agenda 2030 likely to affect markets?
To be honest, I don't really know what those things are. They have something to do with global population, right? And if that's the case, they're irrelevant because population growth is already grinding to a halt in the developed world. You're seeing birth rates plunge almost everywhere in China and India, as well as here in Japan and to an extent Mexico. The only places where population is still growing quickly is the Middle East and Africa. But everywhere else, populations are going to stop increasing shortly, and they're going to start declining in a really dramatic way. So I think, let that trend continue for a couple of centuries, assuming we don't destroy ourselves in some other way before that, and there will be like half the number of people in the world as there are today. And I just saw an interesting explanation of why that's true, why birth rates are plunging around the world. And it's urbanization. Because the social pressure when you live in a village to have babies is really high. You got your aunts and your mom and your grandparents all saying, when are you going to give me another baby? And your friends are all having babies. So it's easy to, pump out 4 or 5 kids. But if you're working in an office in a city, nobody cares if you have babies. Your office mates are exhausted if they have kids, and they're and they don't really want you to have kids because then they have to do your work while you're out. So the social pressure is to not reproduce rather than to have a giant family. And as we urbanize, population growth is slowing down, and it will eventually start plunging. So yeah, I think that's a big change that has phenomenally good aspects to it for the environment, and then scary aspects financially, because there won't be enough young people to support all the old people. So that's probably a subject for another day, but it's an interesting subject.
We're hearing there are human and animal health concerns surrounding 5G and the Internet of Things. What are your thoughts on 5G?
My wife knows about that, and she's not going to let me ever have 5G because it does sound like there are concerns with what electromagnetic radiation of that type does to people. It's just way more powerful than the Wi-Fi that we have now, and it potentially disrupts cellular function in ways that sound pretty scary. And we got to wait and see what the research really says about it. And maybe let some early adopters be the experimental subjects for a few years. But I think that the jury is still out. And if so, it's a really scary prospect that we're rolling this thing out all over the world, when we may not have all the information that we need as consumers about how safe this stuff is.
What do you think is going to be the next hot sector?
Oh, well, clean tech is going to be big. And we talked about electric cars already. Solar is still exploding. It gets cheaper and cheaper year after year. And it's crossing lines in a lot of different markets called grid parity, where a solar panel on your roof generates electricity that is cheaper than what you could get from the local utility that, burns coal in a distant plant and ships that electricity to your house on high-powered wires. When that happens, there's no real reason for these big power plants anymore. And batteries are getting cheaper and cheaper too. So you don't have to worry about when the sun goes down, there's no solar power. You just generate tons of solar power, charge batteries with it, and at night the batteries run the economy. So I think that's going to be a very big thing too. There's all kinds of biotech that's interesting going forward, virtual reality. They're amazing. Cultured meat is going to be fascinating because that's one of those things like solar power that'll get cheaper and cheaper and cheaper on an exponential curve until it's cheaper than, in the way solar is cheaper than coal, ground lab-grown meat will be cheaper than hamburger. And the burger that you get at McDonald's that is lab-grown will be $1 or $2 less than the burger that you get that is grown on a farm where you only use half the cow and, it's incredibly wasteful, immense amounts of water. So that's great for the environment and it's good for the economy because it's going to be cheaper at some point soon. So I think cultured meat, lab-grown meat, fake meat, vat-grown meat, whatever you want to call it, when the time comes, we'll come up with a good name for it. But that is going to be a gigantic market because you can do the same thing with fish that you do with hamburger. And, so there's going to be pork and you name it. And then it gets weird at that point because, just as easily as you grow a pork chop, you'll be able to grow tiger steaks or Angelina Jolie or something like, it's going to get really, really strange when we can make meat out of pretty much any cell culture. That's one of those weird side effects of an otherwise good trend, but I think it's just going to be a fun subject to talk about as time goes on.
In theory, if you bought 10 penny stocks, how many would be winners and how many would be losers?
Oh, that's an impossible thing to answer because, it depends on the sector. If it's a really hot sector, pretty much all the penny stocks are winners, but that's very rare. The dot-coms back in the day, anything with .com in its name went way up for a while. And I think in the not too distant future, anything with silver and gold miner in the name will do that too. When gold is on its way to $10,000 an ounce, new money is going to be pouring into the junior mining sector. And that's going to bid up the prices of the junior miners in ways that won't make any sense to the industry insiders because you'll see things tripling and quadrupling. And even at that higher price, even with gold way up, the given mine that company owns still isn't viable. But it'll be a growth stock and everybody will be talking about it. That's when you want to sell your junior miners to the new dumb money that's coming in. And that'll be a problem, but it'll be a fun problem to have, trying to decide how far to ride these things before we sell out.
What's the latest in health and wellness?
Well, I think biotech and medical technology are just roaring right along. And the time will come, healthcare is this hugely expensive, impossible thing to manage, but the time will come when it gets a lot easier because what used to take $1 million worth of treatment can be fixed with a $1,000 injection, And for instance, just today, a headline came out about how some scientists might have come up with basically a one-size-fits-all antiviral, where you can give somebody an inoculation against basically all the viruses you want to fight with one shot. Now that is extraordinarily financially beneficial for the world, right? We don't have these pandemics anymore, and And we don't have to treat people who are sick for long periods of time in hospitals. You give them the injection, and it's like it was with polio. You just don't get it anymore. That ceases to be an issue. Stuff like that is coming. And then stem cells, where we regrow tissues. For instance, I have a messed up hip from too much basketball and jogging back in the day. And I'm watching what they're doing with stem cells in sports medicine departments and places like that. And it's fascinating because, they take some stem cells from your fat tissue, multiply them, and then put them back in a joint, for instance, that has a problem. And those stem cells somehow know to regrow cartilage right there, or at least to do things that make the pain go away. Soon we'll be able to do that with virtually everything. And that's going to be an amazing thing too, because that's something that scales in a nice way. It gets cheaper and cheaper as we get better and better at it. So it won't cost all that much to regrow heart tissue, compared to what open heart surgery costs today. Those are all huge positive things. So if we can just get by this crazy financial crisis that's coming, we have a much better world out there, thanks to a lot of these new technologies waiting for us.
Do you have some market wisdom for us before you leave?
Yeah, get ready for crazy times. What you think of as normal right now, in other words, low interest rates, fairly stable financial markets where the asset prices go up and up and up year after year, that's not normal. That's an artifact of a massive credit bubble in which the government is creating huge amounts of new currency and just tossing it out there, and it's making the price of things go up and making life easy for everybody. But that has a downside, which is that the value of the currencies that they're using to prop up all these asset prices will start to plunge at some point. And when they do, the government will lose control of the system, and what went up will go back down, and what was easy will become very hard. So I counsel caution now, do things to protect yourself against future problems rather than to take advantage of huge future opportunities that you see right on the horizon. I think the big opportunities are later, except for gold and silver, which are here now. But most other things have this huge valley that they have to go through. And then at the bottom of the valley, it'll be time to just scoop them up again. But I don't think this is that time.
John, thank you so much for being on This Week in Money.
Thanks, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Coming up, Eric Hadik, next on This Week in Money.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. I'm speaking with Eric Hadik, CEO and President of InsideTrackTrading.com. Welcome back to the show, Eric.
Oh, thanks for having me back, Jim.
Eric, swine flu, Zika, SARS, and now the coronavirus. How have these virus scares affected markets in the past, and how are they being affected now?
Well, I think they've had different effects in the past. You always get an initial panic reaction. Sometimes that's more in equities selling off. Sometimes it's more in something like gold rallying. And you've seen a couple of very brief and limited spurts like that in both of those markets with the coronavirus. But I think in this case, and the way it's being handled, it certainly has the potential to have a little bit more long-lasting effect, where China and China's economy and productivity are concerned. And it'll be interesting to see. It's probably one of those things that doesn't materialize right away, at least not all of the unintended consequences. But I think over the next 3 to 6 months, it could have some significant impact on different economic numbers and perceptions. China was already struggling leading into this with more signs of a slowing economy and the trade war having an impact. And now this is one of those things, could be like the straw that breaks the camel's back. And I'm not trying to discuss anything sensational or real extreme, but something that just solidifies the struggles they've already been having. And that's something that, it's now become the case when China sneezes, the globe sometimes catches a cold. So their economy and their equity markets could have a contagion type of effect in the coming months.
When SARS broke out, China was about 5% of the world's economy. Now they're close to 20%. Does that change the whole picture as well?
Well, that just reinforces that exact point, is that this could have a much broader effect. In one respect, I think most everyone agrees that China's being far more transparent and far more proactive this time around, whereas they were accused with SARS of really hiding things and masking things and covering them up. Problem is their proactivity will certainly yield dividends where the containment of the disease is concerned, although it's becoming clear that even that and the delay in December allowed this to morph into something much bigger than might have been the case. But that proactivity could also have the other side of the same coin being negative, where their productivity is concerned. When you've got more and more areas being quarantined and effectively shut down, they may not be the epicenter of their manufacturing and productivity, but over time, as it continues to stretch that circle farther and farther, it has those ramifications and those unintended consequences that are rippling out through the nation.
Do flu and virus scares follow a cycle?
To some extent, I believe they do, but it's more limited time frame and data that I have done any research on. And I even wrote about this back about 10 years ago when you had seen this a lot of for the prior 100 years or so, you had seen kind of these upticks in different flus and related viruses, which they even say coronavirus acts a lot like the flu in many respects. But you would see those spike up on about a 10 and 20 year cycle, often happening between the 8 and 9 year of the decade and stretching into the beginning of the next decade, all the way back to your Spanish flu, which I think was 1918, something like that. I haven't looked at this for a while, but I might be misquoting that. But that you had just a recurrence of that on an approximate 10, 11 year basis. And that even is intriguing to me because there are so many things on a approximate 11 year basis that even ties into the solar cycle. And I'm not saying, and this is one thing where I always try to stress, I'm not saying causality, but there appears to be coincidence. And that's the big distinguishing factor. It doesn't mean that one causes the other, but what it might be showing is that there are these bigger overriding cycles that impact all of these different things. I talked about an uptick in seismic activity that I thought we would see, and even volcanoes in 2019, 2020, going hand in hand with this solar cycle that was primed to turn up, and they've started to see evidence that the new solar cycle did begin in late 2019. And at the same time, you've seen different market similarities and even things like disease. And it doesn't mean that one causes the other, but that there seems to be some sort of cyclicality to a lot of these. They all have a destabilizing effect, and whatever that overriding cause is, these are each the either, whether you want to call them symptoms or manifestations, corroborations to this bigger overriding cycle.
The U.S. markets continue to hit new highs. Do your cycles give you any insight to when these markets could peak?
Well, one of the things that I keep talking about, and every time that it reinforces itself, it just amazes me how accurate, almost uncannily accurate, it has been over the last decade, and even more so in the last 2 years. And it is a 2-year cycle that I have talked about. And I really did some in-depth analysis and published several papers on it back in September 2018. And at the time, I was expecting it to trigger a sharp sell-off in the stock market in the fourth quarter of 2018. And that had some similarities to 2 years earlier and 2 years before that and 2 years before that. And even as I was writing that, one of the things that I identified was how the beginning of each of those years, those even-numbered years throughout the last decade, had begun. And what I wrote back in September of 2018 was that if you looked at the prior years, you could see that in 2010, the stock market had a sharp decline that bottomed in the very opening days of February 2010, and then it rallied from there. 2012, there wasn't really an occurrence of this, but then in 2014, you saw about a 7.5% decline in the Dow, and again, it bottomed in the opening days of February. Then 2 years later, in 2016, it was a sell-off of one larger magnitude. And again, it bottomed in the opening days of February after a 14% decline. Following that, in 2018, about a similar decline, about a 12% decline in the Dow, and it bottomed in the opening days of February of 2018. And so there were a couple things I took from that. When you looked at 2016, at the time in 2018, the 2016 was the most recent occurrence of this, and you followed the pattern, the general pattern that unfolded in 2016, it ended up setting a important peak in the September time frame and seeing a sharp sell-off in October, and along with a lot of other indicators and cycles that I was looking at then is why I was forecasting a sharp sell-off in fourth quarter of 2018. Well, as that obviously unfolded, and even throughout 2019, the markets followed from a general perspective. I'm just talking about some overall swings and cycles. It followed what had happened on this 2-year cycle. And as we came into December and then early January of this year, I was explaining why I thought we would see another sharp sell-off in late January. In fact, if you went back to 2018, the markets topped in the second half of January, saw a quick sharp sell-off, and bottomed in the first couple days of February. And there were a lot of other factors this year that were saying the same thing. In the Dow transports, which lead a lot of these downward reversals, they had a very consistent 11 to 12 week cycle that was saying they should turn down right after mid-January. And there were this 8-month and 16-month cycle that I have frequently cited. They were also showing that we should see a sharp sell-off in late January. And along with this 2-year cycle, it looked like we should bottom in the first couple of days of February and then see another rally from there. Sure enough, the equity markets topped starting, some of the indexes started on January 17th, 18th, some waited till about the 22nd, and then we saw this sharp sell-off into February 3rd, set a bottom, and then rebounded. And even if you just, if you just look at that late January period, you can pick out a slew of stocks that saw anywhere from 7-8% upwards to 10 to 15% corrections right in that time frame, exactly when these cycles and indicators were projecting it. Even a stock like Apple lost 8% in less than a week, bottomed on February 3rd. Something like Starbucks, it had a 10% drop in late January, turned right back up on February 3rd. You go through the Dow, and I just list many of the components, whether it be even 3M, had a 15% drop from mid-January into February 3rd. Other ones like Exxon and Chevron lost 16 and 14% respectively, plunging into early February and then bottoming. And I could go on, but there was just stock after stock and index after index just reinforcing, and this just keeps happening with the key turning points in this 2-year cycle. It's not that you can look back at 2018 or look back at 2016 and suddenly have a roadmap for every week and every month of 2020, but the major swings and turning points have some uncanny similarity between them. And I'm looking at 2018 and the pattern that we saw then, where you got a good 2 to 3 week rally that followed that, and here we're already into the second week of stocks rallying. And then you saw another downturn in March, and in fact the Dow Industrials ended up spiking to a lower low in April of that year, 2018, whereas several of the other indexes set higher lows. And there's already other cycles that I was talking about back in late 2019 that focus on April of this year. So you already have some possibilities shaping up for the next 3 to 5 weeks. And there are some early warning indications that the equity markets could set a second top right around mid-February, which is right where we are now, and see a new sell-off in the second half of February, and the divergent tops that we're seeing, where indexes like the transports, the Russell 2000, even the NYSE index, are all at lower levels in their January highs, whereas then you've got the S&P, NASDAQ at much higher highs, and a lot of that is thanks to just 5 or 6 stocks that are making up the majority of their advances. So you've got some yellow flags being raised. I'm looking to see if a more specific reversal signal can be triggered after mid-February.
We'll have more with Eric Hadik when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're chatting with Eric Hadik. Eric, are there real estate cycles, and what are they indicating?
You know, because there are so many different regions and so many different factors, I'm sure there are, but you would have to focus on them region by region, and except for the major kind of national cycles. So it's something that I haven't, once I started to research it and see these different variables, and also I have to assess whether I'm going to be able to extract some practical information and analysis from that is really going to help my readers. And so I have never gotten to the point of definitively identifying any of them. So while I'm sure there are, because there are in interest rates, there are in inflation, which have big impacts on real estate, but I really couldn't tell you specifically what they are.
Should we be watching gold and silver to see if they lift off from this trading range?
I think that at least in the coming months, that gold and silver and gold stocks are going to have a little more trouble sustaining up moves. I do think that there is another up move coming, leading into the next cycle high that I expect in March, possibly stretching into April. Between now and then, probably in the next 2 to 3 weeks, that should become more specific and hone that down to a tighter time frame. But already there's indications that if we did see another rally into that time frame, that gold, the metal, would probably reach new highs, whereas silver and perhaps even the XAU index could peak at equal or lower levels. So it could be the start of a series of some divergent highs, where if gold remains the leader, it's the one accelerating to new highs, while the others are languishing below their previous highs. And I don't think it's going to be until the second half of this year that we get into more of a position where you could see another sustained move up across the board.
What are you seeing in the cycles for the U.S. dollar?
The U.S. dollar just continues to really stay in a wide trading range. If you take the 1 year move that the dollar had right after the election in our country, that it has stayed in the range that it set in that first 12 months basically since then, and I don't really expect that to change a whole lot over the next 3 to 6 months. I think on a longer term basis, you could see the dollar see a little bit more selling later this year and perhaps into its next multi-year cycle. But for now, I think that we're going to continue to see the congestion we've seen. Basically when I described that in late 2016, early 2017, the dollar index peaked around 103 to 104, and it dropped for a year into January of 2018, bottomed around 88, and ever since then, we kind of saw a sharp rebound into third quarter of 2018, got back up to around 97, 98, and it has it has edged higher from there, but it's struggled to really sustain anything or to break out. Instead, it'll spike maybe a point above its previous high and then immediately go back into a trading range. And I think we're going to continue to see more of that in the first half of 2020. It's once we get past mid-year that I think things could open up a little bit more.
What are you seeing in the cycles for the Canadian dollar?
I really don't have a strong conviction where they're concerned. I do periodically discuss more kind of a 3 to 6 month, 6 to 12 month outlook there. I have definitely been watching the support right around 75 against the U.S. dollar, and we've been bouncing back off of that again. But I don't, other than expecting similar congestion there, I don't have a strong feeling about the Canadian dollar. I do think that as long as that 75 level holds, that it could and should edge higher into the third quarter of this year and perhaps make it back up to 79 or so. But for the most part, I think it's kind of like the dollar, the U.S. dollar, in that it really is more in a sideways trading pattern.
Eric, how would you sum up what's happening right now, and what do you foresee over the next year or two?
Oh, I don't know if I could sum that up into anything concise. I think that we are definitely going to see more volatility, and I think even more surprises as we evolve through the election cycle here in the U.S. And while that may sound too U.S.-centric in its perspective, there's a lot of reasons that I think that will reverberate out around the globe, whether that be the trade war, and if President Trump starts to feel pressure to spur things ahead, if there is any signs of slowing in the economy, or if the stock market started to correct a bit. That's been the thing that he's been standing on for most of the last 3 years. So if we start to see the Democratic field clear up and give a clearer sign of who the candidate's going to be, I think it's going to have a lot of volatile, 1 week being very negative, and all of a sudden the next week just the opposite on a lot of the markets. And that is really consistent with some of the cycles, even when I was just talking about gold, about the dollar, about the stock market, that it's more likely to be multi-week trends instead of multi-month trends, and it's less likely to see really sustained moves in either direction. I think there's going to be a lot of opportunity on 1 to 4 week and 1 to 2 month basis, but that it's one of those things where you might get hurt if you try to get married to any particular position and not recognize the volatility risk that is probably going to be out there through most of this year.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and president of InsideTrackTrading.com. He was speaking to us from the Chicago area. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Rubino, and Eric Hadik, and thank you for listening. If you have any questions for the show, you can send them to info@housestreet.com. Now stand by for a company showcase update from American Manganese CEO Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. My guest is Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Always a pleasure, Jim, and I would like to wish you a happy Valentine's Day.
Yes, do we have any sweetheart deals happening out there in the markets for American Manganese?
Well, if we did, I wouldn't be allowed to talk about that on the show, but yes, we have some things hanging, but, until it's done, it's no point in talking about it at this point in our conversation, but there's a lot of exciting things happening. Of course, we know that the whole industry has slowed down a bit because of the coronavirus, and, you're seeing companies like even Jaguar cutting back on their production of EVs and production of batteries, and so it's a hardship that goes right across the whole industry. But what I'm reading about the future of recycling batteries is encouraging. Not just encouraging, it's exciting. For example, I see there's a lot of people that write up on recycling and forecasting and all this sort of endeavor. But, when you see something like the analyst point of view from one, and I'll be attaching this to the podcast, but the revenue in 2019 is expected to be about $4.3 billion for recycling of lithium-ion batteries. And that is to grow to $25.36 billion by 2026 at a CAGR of 28.7%. That's a staggering amount of money that we used to see in production of batteries. But now, if recycling grows this rapidly, if it even grows half that rapidly, it's a big market out there. And do we think we'll corner it all? No, not at all. But we can certainly provide the tools to bring people into alignment with what governments are requesting, like the podcast or two ago I said, China had introduced new policies of having 98% recycling and recovery of cobalt, nickel, and manganese, and 85% of lithium. That puts us square into that that spectrum of I guess you'd call it being able to provide these things. And I'm not sure how many other companies claim to provide it or actually have proof they can provide it, but we have proof out there from our pilot plant. And speaking of that, Jim, I've been talking about getting the DOE samples, and from now on, I won't be forecasting so rapidly, because there are things that develop that slow down the actual work, R&D work that's being done. Some of it's totally out of our control, and some of it's totally out of Chemetco's control. But so I didn't have a release out this week like I hoped, but I keep hoping that next week will be different, and we will have a release out. But on other fronts, we're getting some exciting feedback from some of the work that we're doing, and we're getting some exciting feedback on some of the potential financing that may be available out there. So we're very encouraged. I mean, this is Valentine's Day. I wished I could say, wow, we just had a takeover bid at $10 a share. I am very encouraged by what's happening. I know that some of my shareholders are getting, impatient, as I am. I'm impatient too. I mean, I want to see things happen more rapidly. I think that we're square in the middle of an evolving market that's going to, pay dividends to people that are involved in it, and we're involved in it in a big way. We've spent several $1 million getting to where we're at, and we've used an independent lab. It's arm's length. Everything that we put out there is from work that they do, and their reputation as one of the best-known research and development labs in North America is on the line. So they're not going to feed us a bunch of crap. They're going to give us the results that they get, and we publish those. So, what people are impatient. They say they believe it. They believe that this is a great story. It's a great technology that's been patented. And why hasn't anybody stepped up to the plate? Well, it is just starting to reach that point where people are starting to think about what they want to do with the environment in the future and how they want to survive in an environment where they have to do something about their batteries besides burn them. So, yep, I'm looking forward to another good week next week. I did publish another article and on the Economic Standard, where we had great success of totaling 116,000 by two articles. I don't know what this one will do. It really depends on what's happening at the time, and whether it's going to be controversial. So we're hoping to get a whole whack of new openings, but only time will tell. And the company's profile is large. We're out in front of a lot of people. People that we talk to, have heard about us. They've contacted us, and that's the best kind of going ahead on any kind of a deal that we're going to make, is having them contact us rather than us grinding the phones and grinding the emails and grinding everything, trying to get their attention. When they want to know something, we know that we've got their attention already. So it just takes a little patience, and that's something that I've learned in the market, that patience pays off, and I hope that my shareholders realize that.
Larry, for people new to American Manganese, what's the company all about?
American Manganese is a critical metal company that developed a process for treating low grades of manganese, which is, in my opinion, the most critical metal in North America, because we have none of it, and that puts us right square in Arizona with a huge deposit that could be developed in an emergency, and should be developed sometime in the near future, but we need the manganese prices to go up again on the metals and the dioxides of manganese. The Chinese control that. But we've spun off another two technologies that we've patented for recycling lithium-ion batteries in order to do with urban mining. And that gave us a huge head start on other companies that were looking at it. So, now we have developed this process, and we've got up to 100% recoveries and close to 100% purities. So, the proof is in the pudding. You'll see pictures of our powders and everything else that we've done. I never see that with anybody else. So, I have to believe that we are in the lead, and we will remain so. Now, the company can do a lot of due diligence on our website, AmericanManganeseInc.com. You can email us at LREAUGH@AMYMN.com. You can phone at 778-574-4444.
Larry, thank you so much for the update.
You're welcome.
We've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on February 14th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Company Showcase is a production of House Street Media Incorporated.